All right, hi everyone. This is going to be the second lecture on chapter 20. So, where are we at? Where are we going here? Well, last time, right, we looked at partnerships with regard to formation, right? And specifically, we looked at the starting point outside basis, that is to say, from the partner's point of view. And in this framework, we said, hey, there's three things that you can give to acquire your partnership interest. You can give property, where generally the gain or loss will be deferred on that contribution. You can give services, which, depending on the type of interest you receive, a capital or profits interest could be taxable to you, or you could just give cash, right? So that's the starting point. Now we're going to move from the initial basis to the adjusted basis. In other words, basis is not fixed. It's not like when you buy stock for $100, that's your basis forever, that kind of framework for partnerships. In other words, basis is dynamic, it changes. Specifically, what happens as the partnership makes income or has losses, deductions, right? We'll just keep it with income to keep it simple, right? Your basis is going to increase, right? You get that pushed out to you, your share on the K1, right? And then you pay tax on it then. On the flip side, right, later on, whenever they push out the cash to you, that's really, if you think about it, formerly the income you made. And the idea with this is if you paid tax on it before when it made your basis go up, whenever they push a distribution out to you, it makes your basis go down. Now, there are some very specific rules on the type of property, but for purposes of this lecture, for purposes of this chapter, hey, basis is going to make your, distributions are going to make your basis go down, right? And finally here, right, we're talking about our adjusted basis. It can go up, it can go down from the operations, it goes down from distributions. On the back end, right, whenever we have our adjusted basis, we're tracking it. Why do we care about that? Well, if we go to sell our partnership interest to somebody else, right, that's our adjusted basis right there. Likewise, if during the operations of the business there's a loss, right, and it's a passive activity loss, we're going to look to that basis to tell us and help us determine how much of that loss we can use. All right, so here is where we ended right here, right? We were looking at initial outside basis. Now we're going to be building upon that. Now, there are some kind of prefatory mechanical things to be aware of here. So, hey, the partnership, right, they're going to be the ones generally making the tax elections. And one of the things with the accounting periods, most of the time, right, what you're looking at is 12/31 year end with a 3/15 filing deadline. And if you punt it out, right, you extend it, you're looking at 9/15. This assumes a tax year end for the partnership of 12/31. Now, most of the time that's going to be the case, right? But the question becomes, how do you know what the tax year end is? Well, they give you three tests, right? 1, 2, 3, and you have to follow them in this order, right? So, hey, we're trying to determine the partnership's tax year end because the return is due 2.5 months later. So if it's 12/31, it's going to be January, February, 3.5 months later, March 15th. Okay. And we would apply that kind of 1, 2, 3 framework to whatever the tax year end is. But what is the tax year end? So the first test says, hey, you're going to look to the tax year end that's used by the majority of the partners, right? So the idea here is, hey, we have 4 partners who are individuals. All of them have a 12/31 tax year end. Accordingly, the majority of the partners have a tax year end. So our partnership tax year end is going to be 12/31. That's how we meet this kind of framework up here and how it happens, most of the time in practice. Now, it is possible, right, that you could have partners that have different tax year ends, right? And there isn't really like a majority. So what do you do then? Well, then you look to the second test. And what you do is you look at the principal partners, namely those who own 5% or more. And you say, do all of those, the principal partners, share the same tax year end? So by way of example, right? Say we have, I don't know, let's just say 5 partners, right? So this guy is an 80% owner. This guy is a 7% owner, a 3%, I don't know, a 4%. And then, so what are we at here? At 90, 94, and this is a 6%, right? They just own different ownership. Let's say, right, they have, there's not a majority, right? We don't meet this first test. They don't share the majority. What you then do here is you look at the principal partners, namely those who own more than 5% interest. This guy, this girl, this guy, and you say, do all of them share the same tax year end, right? If they do, we'll use that tax year end. If we fail that second test, then essentially what you're going to do is figure out the tax year end that results in the least aggregate deferral of income. In other words, there's a deferral. You can look in the book at kind of the mapping on this. I'm not really that concerned about it because, like I said, de facto, you're looking at 12/31 calendar year end, tax year end. But the idea with this is, by virtue of filing a partnership return and having it be pushed out to the individuals on K1s, there's a little bit of a lag for reporting, which creates deferral for the owners, the partners. So what this says is, hey, you got to run the numbers. We look at 2013 here, for example. You can look at that, but basically run the numbers and say which of the tax year ends is going to mitigate that deferral, right, the most. So don't get caught up in this, right? This is like something that's more like academic than like what you're going to do in practice. Here's a little framework for showing you that. The next rule here is generally, right, we've established the accounting period. Now, what are the methods we're using to, track and report our income, our deductions? Well, as a general rule, you're going to be able to use the accrual method or the cash method. However, there's an exception, right? Specifically, if there is a partner that is a C Corp, right? So partners don't always have to be individuals. It's normally how you think of it, but you could have a corporation be a partner in a partnership. But if you have that and the partnership has average annual gross receipts exceeding 29 million, right? They're considered a large taxpayer, then you must use the accrual method. This large taxpayer standard, that's like 29 million for 2023, you're going to see this a lot. Once you hit this, the idea is, hey, you're like a big boy, you're a big girl taxpayer, you got to use accrual method. All right, some more kind of items here, because right, we were talking about your initial basis. Then we said it gets modified by virtue of the partnership making money, having losses, losing money, right? How does this work? So when we have a partnership, right, and it makes income, for example, let's just keep it as income, but it can be deductions, right? That gets pushed out on the K1s, right? So say we have 100 grand of income, right? You could push that out one way, right? Might just be 25 to each partner, right? That's great, that's fine. However, the IRS says this, right? You need to drill into this income and say, hey, how much of this income was ordinary business income, maybe 75 bucks, versus how much of this income is separately stated income, right? So, and it could be a loss too. When we look at these examples here, there'll be a loss. But the idea with this, what's ordinary business income? This is kind of like operating income from the traditional financial income statement. It's really the income for which you're a business. Separately stated income in distinction tends to be those tax items, income, deductions, losses, gains, that at the owner level are going to have special tax characteristics, right? So the idea with this is if I came up to you and I said, hey, I can just give you 25 bucks, you got to claim as ordinary income, or would you prefer that I gave you $5 of ordinary income and 20 of long-term capital gains, right? All day, every day, you're going to pick this because you get the preferential rate on that. So that's the idea here with separately stated items. They're going to have special tax characteristics that we have to track and push out to the shareholders that they can use on their return, right? So let's look at a simple example here. So this is building off the prior example, some of these numbers, but it basically says, hey, we have an $80,000 loss, right? This is the overall loss, right? Contained in this amount, right? We have some income, we have some short-term capital gains, and we have a deduction for a capital interest that we gave to a service partner. The idea with this is you start with the overall amount. You back out, right, these kind of separately stated items, right? Whatever the leftover is, right, that's going to be the ordinary business loss. Likewise, and once we have the separately stated items, right, we got to separate, then we push it out to the owners, right? So on the 1065, right, you'd see $2,100 on the Schedule K. But on the owners, right, partner one, on his K1, right, he would get his share, right, for the 1/3 ownership. Same with these kind of other items. This manifests, right, so here's kind of a high level, right? We have 100,000 of partnership level income. Hey, 30 of that is separately stated items. 70 of that is non-separately stated. What we then do is push it out to the owners based on our profit and loss sharing ratios, right? That's this kind of item here. Here's showing you, ordinary business income or loss. You'd see this kind of calculation on the 1065. So if we go down here, right, the 1065, there's the ordinary business income. You carry that up to the Schedule K, right? And then here are all of the separately stated items, right, over here. So you can kind of see that, look through there. The idea with it is the Schedule K on the 1065, this mirrors the K1, right? In other words, hey, we had a $60,000 loss here, and that's on line 1. On line 1 here, we're going to have our share, right, based off of, here's our profit and loss sharing ratios. Hey, we have some separately stated items. That's going to get pushed out on the upper part here, right? So that's kind of how it works there with it. What are some examples of separately stated items, right? So you can look at these, right? So like long-term capital gains, dividends, passive activities, charity, 179, credits. And again, why do we care about these is because if you look at each of them, right, they're going to have special treatment on the owner's tax return. You'd prefer that we broke this out, right? That would be a good thing for you if we broke it out. Continuing here, right? Let's talk a little bit about how you get compensated in a partnership, right? So, hey, I'm a partner in a partnership. How does this work? Well, there's essentially two ways that you can get income here. One is you can get your share of the profits, right? That's one way. The other way is we can make guaranteed payments to you. And first off, a guaranteed payment is not a salary, right? It's a separate item. It's on your K1, right? So the idea with it is, how does it work, right? Well, it's where's it at on here? Right, these guys right here. These are the guaranteed payments, right? You do not get them on a W-2. That would be wrong. And let me go back up here. The reason they're called guaranteed payments is because you get them, they're guaranteed, right? If the partnership makes money, you get it. If the partnership loses money, you get it, right? So they're kind of like a salary, but they're reported on the K1 there. Likewise, the idea with them is if you look at how they calculate the ordinary business income or loss, you get a deduction for it on the 1065. So that's the idea with guaranteed payments. What are they? They're separate from a salary, but they are a way to compensate our owners. And how do they work from a tax perspective? Well, it really depends, right? If you get a K1, the question then becomes how much did you participate in this partnership? If you are an active partner, right? You're working in the business day to day, right? You're in it, you're doing it all the time, this is your job. Those allocations, right? Generally, your ordinary business income as well as these guaranteed payments are going to be self employment income. So, what that means is, hey, you get hit with ordinary income tax, plus you get to pay that 15.3% self employment tax. It's a little bit different if you're a passive partner, right? So we'll talk about like active versus passive income. A passive partner would be somebody who's just like, hey, I want to be part of the partnership. Here's 100 grand. I'm gonna go, lay back in my recliner, put my feet up, just relaxing. You go make money with it, do whatever you want. I'll see you at the end of the year. You give me the K1, right? That's more of like a passive partner. So here's kind of the setups with it, right? What is a guaranteed payment? The other thing, right? So we said it's not on your W-2, and it's also not a distribution, right? In other words, it does not affect your tax basis. Okay, some other kind of considerations. You can look at this. These are kind of classic things you would see is, hey, there's potentially a limit on your interest expense for the partnership. Flow through income from a partnership, you could be eligible for the QBI deduction. And then, hey, that also might trigger the net investment income tax. At a more important level, right, when we're talking about partnerships, so far we've said, okay, you got to take the total income, break out how much, right? So like 60 of it is ordinary business income and 40 is separately stated, right? Then you push it out, right, on the K1. The cool thing with partnerships, and I guess I did just say the cool thing about partnerships, right? It is possible the tax could be cool, is that how you allocate these amounts, how you push it out, does not have to be based on ownership interest, right? This is called special allocations. And this is, you get it for partnerships, right? This is really good, right? Maybe we want to give this guy 60% of that amount. We want to give this guy 10%. We want to give that guy 5%. It doesn't have to be, right? If you have 4 owners, it doesn't have to be 25% each. They let you kind of mix and match there, as long as there's like a legitimate business purpose for doing so. But here's an example, right? You have a 25% owner. We could say, hey, they get 40% of the profits. It's like totally doable, right? And the general rule is going to be, as long as there's like a legitimate business purpose and we're not trying to do like tax evasion or really kind of illegal things, you can pick and choose how you want to push out the income and the losses, and they're mutually exclusive, the income and losses, right? You could give somebody a lot of the income and give somebody else a lot of the losses. The general rule is the partnership can pick how they do that. Normally, where you would find these special allocations would be in the partnership agreement, right? So this is a big deal, this agreement in practice. If you're preparing a 1065, like real world, you're doing a tax return, it's not uncommon that you got to dig into that partnership agreement. That'll be a work paper that you got to see, hey, how are they pushing this out? Right? They're doing 10% to that guy, 5% to this guy, 6%, right? Whatever the case is. And again, the general rule is they can do it however they want. However, the exception becomes whenever we had a partner, right? And this kind of like throwback, right? Remember when we said later, we get the gain later? When they contributed property with a built in gain, whenever the partnership sells that, the gain itself is going to boomerang back to them. In other words, you can't specially allocate that at least up to the original amount of gain, right? So the idea with this is, hey, we contributed property with a $50 built-in gain, right? Whenever the partnership sells that, 50 of it is going to have to go on this guy's K1, the one who give it. That's how we get the later. And say there was a bigger, right? You sold it later and there was a $70 gain, right? And it wasn't 50. Well, the idea with this is the first 50, you got to restore this person. The remaining 20, then you push that out in accordance with the profit loss sharing ratios, right? Like that guy right there, right? However you want to, whatever you put in the partnership agreement. All right, so some of this is mechanical. We talked about it. They file a 1065. Generally, you're looking at 315 original due date, 915 extended. We talked about a little bit the Schedule K, right? That's going to have those separately stated items. Ordinary business income will be line 1 on there. That then kind of gets pushed out to each partner on their K1. All right, so let's talk a little bit about how you go from initial basis to adjusted basis, right? The idea is you start right here, right? That's your initial basis. But remember, we said as the partnership makes income, your basis goes up. As the partnership loses, profits and losses, right? They lose, your basis goes down. Oh, hey, there's a contribution, it goes up. So it changes over time. It's not, fixed, one thing forever and always with the partnership. And let me kind of pause this here for 1 second. All right, so let me kind of pull this down. Where are we at here? Here we are. Right, so you started with this, the initial basis. We said it changes over time, right? But how does it change? Right, so we're going from our initial basis to our adjusted basis. And anytime this happens, right, if you haven't picked this up yet in accounting, there's kind of the base formula, right? It's always going to be your beginning plus your additions minus your subtractions gets you your ending, right? So if we look at this for the partner and their basis, their adjusted outside basis, it's what you started with, right? So maybe it's $100. Then, hey, are there any additional contributions, right? Maybe you gave $5. Hey, are there now, did the partnership take out any more liabilities? Oh, I'm on the hook for that for 2 of it, right? Oh, I had my share of income, right? I got $20 of the income, the ordinary business income, and I got $10 for separately stated items, right? So it's going to be 5 plus 2, 7 there, 7 plus 30, we're looking at plus 37. And then the decreases, were there any distributions, right? Remember we said distributions reduce your basis. $5. Oh, looks like we had some losses, right? Or our liabilities went down, right? We don't owe our percentage of liabilities, we owe 2 less. There were losses and separately stated losses of, I don't know, let's just say 10 and 6. So 5 plus 2, 7, 17. We're looking at 23 there, right? So hey, 137 minus 23, Hold on 1 second, I gotta have a phone call here. We're looking at an ending basis of 114, right? And this was like just an example, right? Usually you're going to do this year over year, keep tracking it, keep tracking it, keep tracking it. And the two reasons we care about this, right, is if you go to sell your partnership interest, right, say that you sell it for 200 bucks, well, now your adjusted basis is 114, right? That gets you your gain for the difference between the two. Likewise, this comes into your adjusted basis right here. It's this guy right here, your tax basis hurdle, right? So I'm just gonna make that green right now so we come back to that when we go there. Okay, so this is just saying distributions, right? Sometimes that's called a draw. This is going to reduce your basis. And it's also going to be non-taxable to the extent of your basis. So let's look at two scenarios here. Let's say you have adjusted basis of 100 and 100. Here you get a $25 distribution, right? That takes you down to 75 bucks. Here you get a $150 distribution. Oh, $50 exceeds your outside basis. When that happens, the 50 bucks is going to be treated as a capital gain. And the other thing to be aware of here is your ending basis will be 0, right? In other words, your basis, even though we calculated 50, it can never go below 0. So it gets more complicated if there's property involved and things like that. But for right now, you just need to know, hey, distributions are going to be generally be non-taxable and they're going to reduce your basis. All right, last kind of area here, the passive activity loss rules. So let's just first off talk about the different types of income, right? So when we're looking at, let's just say an individual, right? Anytime you have income, right? Remember like the slides with Kirby and stuff, he's like the income's coming in. You got to put that in the buckets, right? The right type of buckets. So, hey, active income is the first bucket. This is normally going to be your wage income, right? You're active, you're earning it, you're working at your job real hard. Hey, let's just say you have 100 grand of that. Portfolio income is going to be things like interest, dividends, annuities, royalties, right? So there you go. And then passive income is going to be rental income. And then it's also going to be flow through income when you do not materially participate. In other words, this is like whenever you give the money to the partnership and you're just kind of laying back in the recliner. I'm just, go do stuff. I'm not going to be actively participating, right? So here's the question, right? Say that you get 100 grand of W-2 income, and then you get a K-1 in which you're a passive partner that shows a $20,000 loss, right? So if you had a client who came into you and said, hey, I got 100 grand of income and I got a $20,000 loss, am I able to use this loss to offset my active income? And the answer is going to be no. In other words, once you're in a bucket, you stay in that bucket. You can't be mixing and matching, doing this and that for it. So that's going to be the general rule. You can't change buckets there. The next thing is, right, say that, okay, you had your K1 of 20,000. Say you also had rental income of 50,000, right? So then the question becomes, well, can I use this 20 grand to offset the rental income, right? I'm in the same bucket, right? What happens here is you can, it's possible, but we're going to make you jump through some hoops, right? In other words, at the end of the rainbow, if everything's perfect, you can use the 20 to offset the 50. But before we determine that, there's hoops you got to jump through, right? And when we look at the hoops, right, we're trying to go from a one passive loss to offsetting other passive income, right? There's three hoops you got to jump through, right? So say we had, what were the facts here? $20,000 loss, and we're trying to offset the 50 grand of rental income. Well, the idea with this is, right, it's kind of like Indiana Jones in The Last Crusade, right? Whenever he's trying to get the Holy Grail, there's like three tests you got to pass. And, you got to choose wisely, because if you choose poorly, hey, you're not going to be able to deduct the loss, or you'll miss the exam question, right? So you got to be careful here. And essentially what we do is we say, okay, yeah, you can do it, but we have three hurdles, right? And essentially what these hurdles, what we're doing, we're looking at, do you have skin in the game? In other words, what we don't want you to do, and what historically happened and why they made these rules, is we're just going to make up a loss, right? We'll just have some, made up business or something. We'll get a loss right here. And then for our true business, we will, just be able to offset the income, right? That's great. Let's just make up the companies. Congress caught on to this, right? And they said, all right, we're not going to let you make up businesses. In other words, we're changing the standard. We're going to have these hoops you got to jump through. And the best you can get, right, to offset that is going to be based on how much skin you have in the game, right? So we got three hurdles. Let's talk about those. This is just another way of saying that, right? So you got hurdle 1, 2, and 3, right? The first hurdle here is our adjusted outside basis, right? This is what we were talking about. That's this guy right here, right? We said the second reason you care about it is if there's a passive activity loss. The next hurdle is going to be your at-risk amount. And essentially what this means is it's going to be your tax basis, right? Your adjusted outside basis. That first one, right? I think we were making that green, minus any non-recourse liabilities, right? That's going to get you your at-risk amount. And the idea with this is, remember, we're looking at skin in the game, right? So if you have a non-recourse debt associated with your basis, the best they can do is go and take that property, right? The collateral, a secured property. They can't come and get your house. They can't come and get you. So that's not really skin in the game when they can't get you. So we got to back that out to get your at-risk amount. The third item here just says, once you exceed those two first hurdles, if you have a giant loss, right, you can only offset up to the other amounts of your passive income, right? In other words, we're not going to let you create an NOL. If you have a $500 loss, but you have $200 of other passive income, the best amount of that loss you're going to get is 200, right? The remaining 300 you're going to carry forward. It'll be tracked at that level, right? So there is a fourth kind of de facto hurdle. It's called this excess business loss limitation. This basically just puts a cap on the total amount of losses normally an individual taxpayer can take. Not really concerned with that. I'm much more interested in the first three thresholds here. Right, so let's look at an example. It will be easier to show it this way, right? Because sometimes you just see a bunch of words and you're like, what's going on? Right, so say that we have a $10,000 loss, right? We get that on a K1 where, it's a passive loss. We're just sitting back in the recliner. And over here, right, we have $1,000 of rental income, right? So we're trying to use this loss to offset that rental income. So let's track this out here, right? The first thing we do is it's going to go over here into the passive bucket because it's a passive loss, right? We got to keep it intra bucket, right? So we have 10 grand that's coming down the pipeline here, right? The first hurdle, our tax basis, right? We're sitting at 4 grand, right? So of the 10 grand, 4 is going to clear and 6 is suspended, right? This is until later on next year, whenever we get additional basis to utilize it, or alternatively, whenever we sell the partnership interest. But let's just kind of keep following through on the framework here, okay? All right, so we had 10 that came through, 4 clears, right? So we're then moving on to the second hurdle, right? We now got 4, right? Here, our at-risk amount is 3,000, right? Maybe it's 4 minus 1 non-recourse. A lot of times these are going to be the same, right? Most, like in practice, it's very common to have your tax basis be your at-risk amount. In other words, there is no kind of special non-recourse debt, but I just changed it here to show you how it would work, right? So here we have 4. Well, in this case, 3 is going to clear, right? Because we're limited to our at-risk amount, right? So if 3 clears, then 1 is going to be suspended, right? We'll wait until later on next year, whenever the case is, where we get additional at-risk amount to utilize this, right? So here we have 3 that cleared, right? So we're kind of working our way up. So then we're going to move over to the last amount, right? So 3 just work their way over. Let me make that red just to kind of keep it similar here. Right, and the last thing says, okay, we had 3, but our rental income is 1, right? So the best we're gonna get is we can offset that down to 0, right? You can't create an NOL here, all right? So that's the idea, kind of an example. If you look at it high level, right, we had a $10,000 loss, 1,000 we got to use, and then 2, 1, and 6, 9 was suspended at the various levels, right? So it's kind of like 10, 1 of it we got to use, 9 is suspended. And the idea with this is, right, if it's suspended at each level, well, hey, maybe next year some additional tax basis, right? Then we kind of just play the game again because, getting that initial tax basis may increase our at-risk amount. We also have to have some, passive income in that year. But that's the idea, is it kind of gets jammed up at that level until one of 2 things happens. One, we get the additional, at risk, the additional tax basis, or alternatively, we sell the partnership interest. We sell whatever the passive loss is, and we can use these kind of jammed up items to help offset that gain. So with that, do watch the other associated videos. Those are very useful in there in Blackboard, but that's going to be it here for chapter 20.